I agree with you, but I think the meat of the question here is like because the Fed could look at this creation of they might look at this as the creation of credit, right? And
Yeah.
if people are still creating credit by spending, they say, ooh, we haven't gone far enough, right?
Right.
So there are basically two lenses that the Fed could look at this data. They could say, wow, we're really concerned about the consumer. They're about to tap out, which is a phrase you hear a lot. Consumer's going to tap out. I don't really know what that means, but people are saying that a lot. Or
Yeah.
you could look at this and say, actually, the consumer is still spending. We haven't been draconian enough with our interest rate hike. We need to keep hiking until the consumer stops essentially spending on credit. How do you think the Fed is going to look at this data and react to it?
I think it's again a really important insight. And as always, you're doing what we're supposed to do, right? We're supposed to ask questions. We're not supposed to just report facts, particularly facts that have already passed, and say, "Oh, see, we told you." It's to ask the questions going forward, and that is exactly the question, which is how is the Fed going to react to a change in behavior? And this again harkens back to the Volcker problem. You know, Volcker, he's hailed as this big hero, and he broke the back of inflation. Well, but the first part of that story is he actually caused a bunch
Right.
of the inflation because of some bad feedback mechanism in calculating CPI, because it was double counting mortgages and housing prices. And so he was so sure that he should be doing this, even though he was causing his own problem. And I think the same thing is true here is if you're looking at the wrong data, you may make decisions that are antithetical to your stated goal. I think the Fed, and we've talked about this before, is in a box, right?
Yeah.
There is no way out. I mean, they can't keep rates where they need to be to stimulate demand so we can grow our way out of this because of the perception that they caused the inflation. They didn't cause the inflation, right? You know who caused the inflation is Saudi Arabia. Saudi Arabia could easily crush oil prices 50% without even trying hard, right? All they have to do is produce what they were producing 3 years ago, but they decided not to do that. Why did they decide not to do that? That's a whole nother conversation for another day, but they could. And China could clearly open up their ports and get the supply chain fixed, but they're not doing that. So
Yeah.
the Fed has no control over those two things. Zero. Nothing they do is going to change those two problems.
This episode is brought to you by Blockdaemon, the world's leading blockchain infrastructure platform. Blockdaemon's mission is simple. Make spinning up a node so easy a 5-year-old could do it, and so secure that any chief compliance officer in the world could sleep easy at night. In plain English, Blockdaemon allows anyone, whether you're a crypto-native fund, a financial institution, a DeFi protocol, whatever, to participate in crypto more safely. For some, that can mean participating in governance. It could mean gathering real-time and accurate data. It could mean generating yield through staking. Whatever it is, when it comes to crypto, infrastructure is edge, and there's simply no better edge offered than the one from Blockdaemon. Blockdaemon supports a range of services on over 50 protocols, and that's a growing list. They have multiple layers of risk mitigation that include regional and data center diversity, 24/7 human and automated monitoring, a full-service team of engineers to avoid technical difficulties, and things like slashing insurance. In other words, they literally make it foolproof. If your organization relies on real-time, accurate data that comes from blockchains, please, please, please click the link at the bottom of this episode and go check them out. Again, it's important. Gotta click the link at the bottom, otherwise I won't get my credit. I'm curious to like just the devil's advocate argument to that is, they don't have any control over, right, the cost of oil. They don't have any control over the ability to produce wheat, et cetera. But what they can control is obviously the demand side of the equation. And
Sure.
one of the things that you and I have talked about a lot on the show is the wealth effect. So when they lower interest rates, they increase the price of financial assets like housing, right? You can see these an enormous amount of increase in the price of housing that leads to tappable equity lines on those housing, and people just feel wealthier, so they want to spend more. Shouldn't, in the reverse, right, when they raise interest rates, the value of their homes go down, the value of their financial assets go down, everyone feels poorer, so they're not spending on these things? Like, can't they kill demand? You don't think that will have an impact on inflation?
Well, I mean, so let's think about this. So gas prices have gone from $2 to $5 over the past, 18 months or so. And how much has driving shrunk? Not much, right?
No.
Well, why is that? Well, because in order to do your job, you got to get in your car and drive. You just don't have a choice. Now, some people are working from home, but there's a certain number of people, truck drivers, gas station attendants, nurses, teachers, that they don't have a choice, right? So there's a base level of demand that isn't going to change. The other thing is oil and gas usage globally. Everybody focuses on transportation. Like the woman last time, oh my God, the senator saying, well, I got my new EV and I drove here from Michigan and I passed all these gas stations. I just didn't care. Like, well, right. But the average person doesn't have $70,000 to buy a Tesla. They don't. And you can't get one right away, but they just don't have that. And they can't buy that. But the real problem is not that. It's that transportation is only a small part of oil usage, right? There's all kinds of other things. Petrochemicals. Everybody's like, oh, I want us to be carbon free. I don't want us to use oil. Okay. You can get rid of all the plastic in your house. You're going to stop using rubber. There's so many things that petroleum goes into. And then you got the other piece of it, which is natural gas. How are we going to kill that demand? Are we going to change the weather? Right? The real problem is the supply, not the demand. We have supply constrictions, both artificial and man-made. Both natural and man-made. Natural meaning we didn't invest enough in the production of gas for Western Europe, so they're reliant on Russia. And then in the US, we had a whole bunch of bankruptcies in the oil patch, and we haven't seen enough reinvestment. And then we do stupid stuff like, reverse leases. The administration just reversed a bunch of leases for drilling on federal lands. So again, I hear you on the demand side, but I just don't think we have a demand problem. I have said this for a long time. The inflation that everybody's worried about is not demand pull inflation. It's not like the 70s. It is not that we're demanding too much. It's that the supply caused the problem. And that can't be fixed with interest rates.
Yeah, I would agree with you. But I do think, on the one hand, I do think the Fed is genuinely concerned about this, right? Like you can almost sense, you can sense central banks are worried about this. And you're starting to see surprises like the Australian central bank, right? They surprised to the upside, right? They did a 50 basis point hike instead of people are talking about 25 to 40. Indian central bank is turning more hawkish. So, in general, I think central banks are starting to take this seriously. I think the question that everyone is asking is, people talked about the Fed put for a while. Okay, maybe the Fed put doesn't exist at the level that it currently exists, but what are the things that are going to cause the Fed to say, hey, we might have gone too far too fast? It's basically when things start to break, right? So the thing that everyone wants it to be is when equity prices fall to a certain level. It doesn't seem like it's going to be there.
Yeah.
It seems like more the focus is going to be on credit markets, right? So we haven't seen spreads blow out really yet. That's actually because
I think it's the election. Right. I think everybody, particularly people watching things like this, really want it to be financial assets, either crypto prices or stock prices or high yield prices. But it's really the election. The election is really important, and it's really important because people like to stay in power, and the only way you stay in power is if people aren't really pissed at you. And right now, people are really pissed. And in the absence of a material fall in oil and gas prices and a material recovery in kind of consumer confidence, consumer confidence is plumbing lows that we see at recessions. Yeah. And everybody says, well, we're not in a recession. Well, first quarter GDP was negative. Second quarter GDP estimates have fallen all the way down to 0.8, which margin of error says that could easily be negative. And so, and not that 2 consecutive quarters equals a recession. That's not the way it works, contrary to popular belief. It's actually the NBER determines when you have a recession based on 4 big indicators: industrial production, retail sales, employment, and I always forget the 4th one. But we'll see what they say. But it feels to me, other than the ebullience of certain segments, like I said, 20,000 people are going to Austin, Texas to party this week. Okay. That's not recession-like, but that's 20,000 people out of 360 million. You go to, I think, I don't know if we talked about this last week or not, but no, we couldn't have because I just did it last weekend. I went to a lacrosse tournament last weekend and with my son, my 11-year-old, and there were 50 teams from all over North Carolina that came and bought hotel rooms and spent a lot of gas money because they all drive giant SUVs. I had the littlest tiny car, with my little Kia, and everyone else is in these monster SUVs. And so that was impressive to me. That was a lot of consumption going on. People went to restaurants. We went to this one restaurant, hour and a half wait. Now, granted, it was a Saturday night. Granted, it's on the lake, Lake Norman, ritzy place with all the NASCAR money. But still, that wasn't recessionary looking. But I do think it's the top end is still fine, but the bottom end, man, look at Walmart numbers, Target numbers. Those are real.
Yeah. I would say too, we just did permissionless as well. And I heard a lot of people I heard a lot of people saying, look, there's still so much positivity and et cetera. And what I would say is I'm remembering back to 4 years ago, the biggest consensus event, right? Which at the time there were no other events. It was just consensus. The biggest event they ever did was actually in May of 2018. And that was 5 months right after, so it was at the very beginning we were already in this bear market, but it had already started. And I just think sentiment takes a little while to catch up. It feels like we're not at the bottom yet, just because of there is still hope, and we've passed the anger stage into the none of this stuff really works phase.
Again,
I'm talking now specifically about crypto.
Genius analysis, right?
It just lags a little bit.
The lag effect. No, that's exactly right. Particularly human beings, because we don't like reality.
No.
Reality sucks, particularly when reality affects your personal balance sheet or income statement. And we are in crypto winter. We are in a bear market, right? There's no debating that. Yet, to your point, 25,000 people down in Miami for the Bitcoin conference, however gazillion many you guys had permissionless, 20,000 people going to Austin. There is this belief that, we're past it. And now we're going to have this big rally. And I'll tell you, I'm so nervous looking at the chart, the Bitcoin chart in particular. It looks so much like that period right after you described, June, July. It does
look a lot like that.
Kind into November. So there was about a 4 or 5 month window where we bounced around 6,000 over and over, and each bounce was lower. And we went 12, and then we went 10, and then we went 8, and then we went 65, and that descending triangle pattern is a horrific pattern. It is not bullish. It is, and you remember November 14th, bang, we were down 50% from 6 to 3. Not quite 50, but I think we went to 3,200. And that was the bottom. That was the cathartic, oh my God, okay, I got it. And that's when, I remember we issued our Morgan Creek Bitcoin challenge, right? The $1 million charity bet that we would take, Bitcoin, anyone else could take the S&P for the next 10 years. We got crickets. We actually had one person did say he would take it, as a famous money manager. And his son talked him out of it. He's like, Dad, no, we are not doing that. There's only downside for us. I mean, we're in the traditional asset management business. So he didn't take it. But it's a good thing too, because, right, Bitcoin's up 10x from there.
I love when you guys did that. Yeah, should have. I mean, even now, I would take that bet. The Bitcoin.
Oh my God! Right now, let's issue it again. The Morgan Creek, Bitcoin challenge. Anyone listening to this? Jim. I wouldn't do it against Jim because I like Jim. But anyone in the traditional world who wants to take the S&P over the next 10 years, you know what? Dang it! I should have done that on Maria's show this morning. I should have done that.
Hey, we have a bigger viewership than her anyway. So
you know what? It's probably true. It's probably true. It probably is true, especially at 6 a.m. I know we have bigger viewership than Maria at 6 a.m.
100% higher quality viewers, all of you listeners. All right, I've got one more.
That's not even close. Definitely higher quality.
100%.
Because these people actually care about stuff beyond politics.